Hi, hello friends. Welcome everyone to Invest 10, India's largest retail investors online conference. I'm Ashok Devanampriya, the CEO of Traders Gurukul and also the host for your today's program. It's a great pleasure to invite every one of you to Invest in 1.0 conference. I am sure by the end of this program, you will have a lot of knowledge which can help you to make better investment decisions. I would like to thank our media partner, Money Control Pro, the largest financial portal in India with millions of daily readership on their website. I would also appreciate our title sponsor, Sharekhan, one of the leading stockbrokers in India with millions of investors as their customers. The company offers online security brokerage and portfolio management services to institutions, large corporate houses, and individual investors. They've been serving Indian customers from the past 37 years, as you know. The speaker for today is Mr. Aniruddha Sarkar from Mumbai. He is the CIO and portfolio manager at Quest Investment Advisors, managing over 2,000 crores of funds under various PMS, AIF, and offshore schemes ever since Feb 2020. He brings almost 15 years of experience in the capital markets with diverse role managing money for their investors across PMS, alternative investment funds, offshore funds, and advisory business. He has an eye for sector themes and has been instrumental in catching many themes early in their life cycle over the years. So prior to joining Quest, he was with IIFL Group companies for over 11 years. At IIFL, in his role, he was the portfolio manager for IIFL Multicap PMS ever since its inception in 2014, where he generated industry-leading performance over the 5 years till December 2019. And the same was also recognized in industry awards in the year 2019. He holds a bachelor degree in commerce and he's an MBA in finance. So he's going to empower us today with a special topic, Aniruddha Sarkar's investment methodology. Mr. Aniruddha, on behalf of Traders Gurukul, Money Control Pro, Sharekhan, I extend my warm welcome into the Invest 10 conference. Go ahead, sir. The stage is yours.
Yeah, thanks, Ashok, for having me here today on Investin. And I would like to extend an equally warm welcome to all investors and viewers of Investin today. I think it's surely one of its kind a platform wherein I think industry people can share our thought processes with investors who want to definitely make it big in the equity markets. Today, I would basically like to touch upon some aspects which do not get spoken much about. I would not be getting into the financial ratios, balance sheet, or how to analyze a company because I think we have enough kind of books and seminars and workshops on that. I will be basically trying to discuss over the next 60 to 90 minutes the softer aspects of investing, and subsequently to that, I'll go to something which is very close to my heart, which is the sector selection, which, as you mentioned, is something which I have been doing over the years. What I will discuss over the next 60 to 90 minutes is basically the multiple aspects of how we as investors behave in the market and what we should be doing about it to emerge as better investors. Followed by this, I will be talking about how and why markets move through the economic cycles and why those cycles should be analyzed to benefit from, and also how to catch the sectors early on. I would also be talking about some sectors which I see as being the beneficiaries of the current upcycle in the market, which we are seeing as of now. So this will be the broad discussion over the next couple of hours. So before I begin, I would like to make the usual disclaimer, which is, the content of this presentation is basically for information of all the attendees and investors who will be kind of going through this presentation subsequently. I would recommend you to consult your financial advisors before acting on any of the ideas which we discuss in this presentation. Also, me or my clients at Quest PMS might be having ownership of some of these stocks and sectors which we are discussing today. And it's quite possible that we might have entered into some of these names much early on. And we would recommend you to consult your financial advisor before taking any action on it. So Quest is a SEBI registered PMS and AIF manager, and also the final disclaimer is all views, thoughts, ideas discussed today is my own and there is no kind of representation which should be seen done from the Quest investment advisors. So as I mentioned, these would be kind of the main headings over which I'll be discussing the presentation over the next couple of hours. So I would like to thank.
Yep.
Yeah, sure.
Friends, the title sponsor for the event is Sher Khan. So it's a great pleasure to have them on board as the title sponsor, and they have been our sponsor for most of our engagements in the past. More details to follow in the subsequent slides. Sir, over to you.
Sure. So as mentioned, the first part of my presentation will try to capture about understanding the investor behavior, because one thing which I have learned in my journey of the last 18-20 years in the equity markets is that there are some things which can be taught and some things which can't be taught. The things which can be taught are basically how to read balance sheet, how to read the profit and loss statement, how to read the cash flow statement, how do you read and analyze the financial ratios, etc., etc. What can't be taught is something which is inside us, which is basically the behavioral aspect, and that is where I would say differentiates an average investor from a big investor, or an investor who has done exceptionally well in the equity markets. So this is a part which I'll spend some time on, which is how the human mind behaves in the equity markets, and that is where if you are able to understand this part, I think you are able to emerge as a better investor. Now, these four words which you see on your screen, which is like, the drug addiction, equity trading, gambling, and binge eating, all of these are very, very different words. But interestingly, one thing which is very common from all four of this is that in each of these activities, the same part of the human brain gets stimulated and it releases the same hormone, which is dopamine. Now that is very interesting because things like drug addiction, gambling, equity trading, they all release the same hormone in the brain, which is dopamine, and that is something which is very, very interesting. And this is something which kind of leads us to do different behavior in the equity markets with regard to the profits and the losses and the way we do our executions. Now, investors typically, we say that they're the rational investors, but what has been seen by doing scientific analysis of the human brain is that the irrationality starts once we start making the losses, which means that we are rational investors till the point we don't make loss, and once the loss gets involved, we start behaving like irrational investors. Typically, once a loss has been experienced, the pain centers of the brain, they start getting aroused, and the future decisions, they tend to be less rational than before. And this is something which we have seen again and again in every bull market, every bear market, how investors have behaved during different cycles of the market. The most interesting part, which I have seen actually firsthand among many investors, is that people tend to make the riskier bets after they have lost some money, because the general perception is that they need to recover this loss, and on top of that they also need to make gains. So I have seen enough people losing big time because they have become excessively aggressive after making a loss, because they wanted to recover the losses and also make additional gains. Now, this is something on which there has been enough of scientific, I would say, research done on the human behavior and the human mind, which is this is something which is not related just to equity markets, but this is something which is related to other aspects of life as well, which is the anticipation of a reward is more exciting than actually getting the reward, which means that whenever we enter into any new investment idea, the expectation of making a big return is something which excites us more rather than the excitement of actually making some decent return from that investment. And as a human behavior, our natural mental processes, they are designed to be dissatisfied with an outcome, and we always want more. That is the reason why the age-old words of the greed and fear in the equity markets has come to be happening, which is we don't get satisfied, and that is not something to do with you. It is to be done with something, the human behavior, and it is something which runs across all the humans who are there in the market. One thing which we have all seen over the years, I'm sure you would have also experienced in your personal life as you have been investing over the last so many years, and I think the last 2 years would have been a very, very good example, which is failure to take profits off the table is a very, very common problem of most investors. We don't take profits off the table because many a times we keep on thinking that we will make it much bigger, etc. And that is the time when we want more and more. The other side of it is when we make a loss in a particular investment, we don't easily get out of that loss making idea, and we keep on holding on to that loss making idea because there's a big mental hurdle for investors that how do you book a loss. So these are two parts, you can say the two opposite sides. One is when you make a decent profit, you don't take profits off the table or maybe partial profit booking, and the other end is when there is a decent loss in a particular investment idea, that loss becomes a big hurdle in our minds and we don't look at it objectively and rather get emotionally attached to that particular position. And obviously in today's world, if I talk about access to n number of information with regard to different funds, different portfolios, how your friends have done, how your the colleagues have done, continuously trying to outperform each other, continuously trying to do better than the benchmark, continuously trying to outperform your friends and colleagues is something which makes us take more and more irrational decisions and makes us unsatisfied as an investor. Now that brings me to a very, very important aspect of investment, and this is something I always tell investors that spend more time on analyzing risk because ultimately the equity market is all about the risk and return. In any of my investment ideas, any of my investments which I do, first thing I keep an eye on is the risk of that particular investment, because the return part is something which I know if the markets are well, company is doing well, things are well, and my analysis is well, the return part will anyways come. The risk part is something which is typically unforeseen and which typically we don't pay much attention to. As investors, our brains become more risk-seeking during the bull markets, and I think we have seen the last 2 years, wherein that when the things were all moving up, we saw even small companies, without any fundamentals going up, and the same set of investors who have been historically very, very averse to risk, they are also getting into those companies. So basically, during the bull markets, we feel that nothing can go wrong, and that is the time, our brains excite us to take more and more risk. On the other hand, what is interesting is during the bear markets, and I think the last 1 month is a good example, wherein during the bear market, so I would not say that we are in a bear market because someone might say that I'm talking about a bear market right now, but basically when the markets are down, typically our brains becomes more averse to risk. Now these are two things which I find very, very ironical, because during the bull markets getting more averse to risk, and during the bear markets, after the markets have fallen, you become more risk averse. Now people typically think that bear markets are risky, but what one needs to understand that the real building up of the risk happens during the bull markets, because it is during the bull markets that we don't take any caution of what we are buying and how much we are paying, what valuations we are paying into, and which companies we are getting into. We don't spend time in analyzing companies, businesses, sectors, etc., and we get carried away. So typically the risk builds up during the bull markets, that gets visible during the bear markets, because during the bear markets, when there is any unforeseen event, say for example the recent the Russia-Ukraine conflict, it is such events which brings out the risk which was built up during the bull market. Now if you look at the way many of the companies in the micro cap, small cap, or maybe companies without any fundamentals have fallen in the last 1 month, this is not that they have fallen now. They have fallen because the risk was building up when the excitement and the optimism was there in the market. So basically that is what one needs to understand, that be cautious when things are getting over the roof, and when things are all beaten down, that is the time to start looking at good investment ideas. That is the reason there's an old saying that you buy when others sell and you sell when others buy. So this is basically a summary of this idea that risk is maximum when the bull markets are there. As I mentioned, the risk management is a very, very important aspect, and that is why I always focus on investors to understand the risk-adjusted return, that what risk they are taking to generate what return. I can take bets into unknown micro caps, unknown small caps without any fundamentals, maybe very, very small companies, wherein I know that, I can pick up a decent chunk of the company and, ensure the company keeps running up. But the issue is that these are riskier bets, and, one needs to understand at what risk one is taking to generate what return.